Welcome to my channel. I'm Dr. Romano. Today we're going to be discussing why you should not be investing in a hedge fund. I'm going to walk you through as to why and what my reasoning is. A hedge fund is a trader who trades on a particular market. The goal purpose of a hedge fund is to create returns for their clients. So a hedge fund manager is a trader who could be trading by themselves, they could be raising capital, they could be managing the company, etc. Larger hedge funds employ other traders to trade for them. In previous videos, I discussed why larger hedge funds should not be your focus. We're going to be discussing the smaller hedge funds, and based on my research as a PhD graduate, my PhD research has concluded that hedge funds under 350 million outperform larger ones. Of course, you would not want to invest in a hedge fund that is approaching 300 million. You would want to find those smaller hedge funds that are just starting out, that have a number of years trading. However, after 3-4 years, investors see how profitable they are and they start to dump a lot of capital into their fund, creating those $200-300 million funds. I have done a lot of research on many different aspects of hedge fund returns, and because of that, I'm very well equipped with selecting and deselecting a hedge fund for one's portfolio. And this is why I say you shouldn't be selecting the hedge funds, because you can make a mistake, meaning that you would not be able to maximize your portfolio of hedge funds. Because hedge funds have a minimum investment amount, that could be $250,000, $1 million, etc., and they have lockup periods, you should not be focusing on investing directly into a fund. This is where my research shines. The funds of funds business is the future of investing in hedge funds. The public should not be investing or even looking for a hedge fund to invest in. And this is very crucial because I wrote a book, and the front cover of that book is a bunch of golden eggs. And in that book I discuss all the various important aspects and strategies that one needs to know about how to deselect and select a fund. And I did write another book, but that hasn't been published yet, and that goes over the research findings over a 7-year period. So I took my strategy and I researched it and improved upon it over 7 years, and that is my second book. Because I can't give everything away and everything I know, because of course I won't have an edge on the market. And my predictions, everyone will know how I do these predictions about the stock market, about cryptocurrency, about the gold, commodity, etc., and the real estate market. Everything I learned is not that I'm doing magic or I'm psychic. No, it simply is that I learned finance and investment strategies. And when you understand the stock market in depth, you see the big picture, and it's very clear of what happens in a particular market which affects another market. And so I've been talking about an inverse relationship with the commodities market and the stock market, etc. That's one cycle. We also have the real estate cycle, 25 years of a real estate cycle, and we are now approaching the end of that cycle. In other videos I talk about all this. Please remember, before we continue the video, if you do like my content and you want to say thank you, Anthony, please remember to do thumbs up. It's right there. It's 2 seconds, you just click on it. And this will let me know that you enjoy my videos. To continue the video, I want to talk about, if you can't invest directly in a hedge fund, what do? There you go. Okay, so you need a lot of money. And because you may not have a minimum of $10 million to invest in a hedge fund portfolio, this is why I say the funds of funds business is a better alternative to invest in hedge funds. By investing in funds of funds, you are actually taking part in investing in a number of hedge funds. Every portfolio manager at a funds of funds has a different strategy and a different approach and a different amount of hedge funds in that portfolio. It is based on AUM, capital under management. So if you have $1 billion, let's say, of capital, well, the typical 8 to 10 hedge funds would be actually not enough. And so you would have to select more hedge funds to reduce your risk. And so this is another factor as to why funds of funds is a better alternative to investing directly in hedge funds. Because you're reducing your risk by investing in a number of hedge funds. Now, that risk could be no more than 10% of your capital. It could be no more than 5% of your capital. It just depends. Now, of course, if you select too many hedge funds with your portfolio, your returns will be watered down. And this is a big problem in selecting too many hedge funds. So the portfolio manager of that funds of funds needs to understand what type of market are they trading in, what is the future type of market within the next 3 to 5 years, and how to position different hedge funds that will do really good in that coming market. So for example, let's say we have a couple of years of a kind of stagnant market. Typically, when we have a president who is about to end their presidency and a new one is going to be introduced, and it's for sure that was the president's second term, let's say, the markets over the last 2 years of that 8-year period is going to kind of be stagnant. Because the most important thing in a market is the taxation amount. Whether or not they're going to increase taxes or decrease taxes. And there's always 1 year lag effect in the economy. So when the government takes in more taxes, the following year they actually take in less. So raising taxes is not the way to pay for the government's bills. There's actually other methods that could be done, like cut the budget by 10% per year over a 5-year period, or try to have a balanced budget and over a 35-year period, that government debt will turn into much less in value. This is a big factor, and understanding all this, understanding finance and how the markets react to a different president taking over, whether or not Congress is going to be mostly Republican or Democratic. There's so much to understand, and just selecting 10 hedge funds, you're not going to understand all this. And so that's why it's best to invest in a funds of funds. A funds of funds is a portfolio of hedge funds, and they take the responsibility into their own hands on predicting, basically, the future of the next 3 to 5 years, what the market's going to be like. And then they allow and give the responsibility to those hedge fund managers, who are traders, to manage their own risk and their own company. Remember, as I mentioned in other videos, investing in investment banks who employ thousands of traders isn't always the best. Because when a trader is an employee at a company, their risk profile and their returns are totally different. And so based on my research, the data suggests that they're basically trading they're afraid to trade. And so their returns are mimicking the fact that they're kind of hesitating to trade. Whereas someone who goes off on their own and starts trading capital, they perfect their strategy, they perfect their exit strategy on a trade, that's called risk management. I also have an MBA in risk management. That's my second MBA, but my first MBA was finance. And so I also worked on the trading floor at an investment bank. And so I got firsthand exposure to the investment bank trading books. That was my job, to review the trading books before the chief financial officer would look at those profit and losses. And so it was all about me basically scrubbing the data to make sure it's accurate, it's on time. If it's in red, meaning if it's overexposed, what exactly is going on and what are they doing to get out of exposed. And so I got to see the different data between the data at an investment bank, at a trading desk, and the data at a hedge fund. It's very different when you trade on your own because you have the responsibility to manage your fund. There's nobody standing over you telling you what you can't do and what you can do, afraid that the risk manager is going to come over to you because you're losing too much money, etc. All that is a psychological, it affects you psychologically because you're like, oh my God, I have to keep my job. What am I going to do? And so logically, you're not taking the responsibility into your own hands. And I've also studied psychology for my undergraduate degree, so I love organizational psychology. And why is it so different that the entrepreneur side of the brain, that type of personality, becomes so successful? So just because you're an entrepreneur, it doesn't mean that you're going to become successful. The difference is that those successful people, it has nothing to do with how much money you make. It's the fact that they don't stop in learning. They will not give up. I want to thank you so much for watching my video. Please remember, if you like my video, to subscribe to my channel so you get my future videos. And please, if you want to say thank you, Anthony, and you appreciate my content, please do thumbs up. It's right there. And then finally, please remember, if you want to send me any questions that you have, send it to the live chat and I'll respond back. If you have anyone else that wants to watch my videos, please remember to use the share button. It's really easy. You just click it and send it to them. I want to thank you so much for watching my videos. Thank you again.